Hi, and welcome to the latest edition of the JMI Wealth monthly video series. Now, we're recording this in October, so we've seen the end of the third quarter come and go, and we've seen a continuation of the theme of a tumultuous year for financial markets. Now, at the last video update, we discussed inflation and the steely resolve of central bankers around the world to quash, to sit on inflationary expectations. And the last month has delivered plenty of opportunity for central bankers to demonstrate that resolve. In early October, the Reserve Bank of Australia raised the cash rate across the Tasman by 25 basis points. The local bank, the RBNZ, lifted our cash rate to 3.5%. And in the US, the Federal Reserve in late September pushed their Fed funds rate up over 3%. Now that's the highest Fed fund rate we've seen since the GFC, since 2008. There's been a host of other central bank activity as well. The thing is, we've also seen estimates for the peak cash rates that may be seen. They're starting to be lifted as well. And domestically here in New Zealand, the markets are pricing the official cash rate to top out potentially as high as 4.75, where only recently 4% was seen as that sort of terminal rate. In the US, a similar peak may also be seen, but not only have the expectations for those peak rates risen, but the expectation is those elevated cash rates, they'll need to stay in place for longer than initially anticipated to quell those inflationary expectations. We've got concerns around inflation, we've got the higher level of interest rates, we've got the impact of those higher interest rates on consumer disposable income, all weighing on growth expectations, and in turn they've combined to place more pressure on share markets right around the world. And the September month in particular was a tough one for global share market indexes. One of the key observations we're attempting to make right now is whether or not this spectre of higher interest rates and potentially lower growth is actually starting to be felt. Are we seeing any moderation in demand, moderation of activity? Look, I think the answer is a tentative yes, but that moderation is not yet flowing into, it's not yet reflected in inflationary data. Housing markets in Australasia and the US are definitely weakening. And this in turn impacts on the so-called wealth effect. Now you combine that with higher mortgage payments as the bank pass on the higher wholesale rates to their customers. This means there's going to be weaker consumer spending. But arguably the most important factor is the labour market. All over the world, employment is running at historically high levels, which combined with that rising cost of living gives rise to this potential wage price spiral, high wages, high prices, high wages. Now, all data releases relating to labour markets at the moment are being very keenly followed. Look, it's also been a quarter where we've seen a lot of volatility in currency and interest rate markets. Now, currency markets have been dominated by the strong US dollar. This has resulted in currencies like the New Zealand dollar trading at levels against the US that we haven't seen for years. Now, this is great for our exporters. They receive more in local currency, in particular for goods that trade in US dollar terms, and dairy is one example of that. But this stronger US dollar makes imported goods more expensive, and this is a real headwind for central bankers trying to control inflation. But look, buried sort of deep within the central bank positioning and the market turmoil, there are seeds of optimism. Share markets are now far more reasonably priced than they were, and there are signs that inflation over the rest of 2022 will start to soften. But central bankers are going to be loath to repeat the mistakes of the 70s, and they're going to be reluctant to ease off the monetary policy pedal until there are clear signs that inflation pressures are moderating and inflationary expectations are falling as well. We continue to be cautious, as we have been for much of 2022. Interest rates are definitely looking more appealing than they have been for some time for investors, and we continue to believe that in the short term, the Australasian share markets are likely to be more defensive than other offshore jurisdictions. So look, navigating financial markets is certainly challenging at the moment, so having an experienced financial advisor who can help you sort of travel through and navigate that volatility and help you make prudent and sensible decisions along the way is a really good idea. So why don't you visit us at jmiwealth.co.nz and get in touch with us to discuss your financial future.